Hi, this is Professor Marsh, and this is the homework lecture for Accounting 432, Individual Income Tax, Chapter 3. The problems that were assigned were problems 2, 4, 12, 17, 38, 46, dyslexic here, 54, and 62. And there was a comment about question 66. So in question number 2, this was to describe the three parties engaged in every business transaction and how understanding taxes may aid in structuring transactions. Just don't forget that there's the taxpayer, the other transacting party, and the government. The government is always involved. The taxing authority is always involved in every transaction. So those are the three parties who were involved. Okay, number 4. The two basic timing strategies are pay the tax later, that's the time value of money, and pay the tax at a lower rate when they change. Okay, so those are your two basic timing strategies. Go into the question of whether or not you want to take the income now or next year, whether you want to take the deduction now or next year, or perhaps whether you want to engage in one of the deferral transactions that allow you a longer deferral than just year to year. So, okay, number 12. What two factors increase the difference between present value and future value? So the two factors that increase the difference between present value and future value are rate and the number of periods. So the interest rate or the rate of return and the number of periods between the present and whatever future date you're making your calculation at. Number 17, why is paying dividends not an effective way to shift income? And the answer to that is because for a regular corporation, there's going to be double taxation. The corporation itself pays tax on the income, and then the shareholder pays tax on the dividend when the dividend is received out of a regular corporation. So there's no deduction for dividends paid at the corporate level. Okay, that's number 17. Number 38. All right, let's see if we can find number 38. That's way back further in the book. So this gives us the question about Isabel, who's a calendar year taxpayer, and she uses the cash method of accounting for her sole proprietorship. In late December, she received a $20,000 bill from her accountant for consulting services related to her small business. Isabel can pay the $20,000 bill anytime before January 30th of next year without incurring a penalty. Assume her marginal tax rate is 37% this year and next, and that she can earn an after-tax rate of return of 12% on her investments. When should she pay the $20,000 bill? This year or next? Well, the $20,000 bill, let's see, do we assume? Yeah, the rate's going to be the same this year and next year. So the time value of money, there's not a change in rate. Paying at a lower rate is not part of the timing strategy. So it's just basically, pay the tax later or get the deduction sooner. So if we can get a deduction this year and then earn a rather heroic rate of return of 12% on investments, then that's going to be a pretty good thing. So $20,000 times 37% is $7,400. So if we can get a $7,400 tax break, right, the marginal rate of 37% times 20,000 is the amount that we'll be able to reduce our taxes by this year if we make the payment before December 31st, or on or before December 31st. So if that allows us to pay our taxes 1 year later, instead of paying them on April 15th of next year or April 15th of the year after next, and if we're making 12% a year, then we're making 1% per month, right? 12% divided by 12, we're making $74 a month. So 74 times 12 is $888, and that's a pretty good savings. We'll be able to earn over the next year $74 a month, potentially up to 12 months, because we took the deduction this year. So that's a good thing for Isabel. She's doing quite well for herself. Okay, let's go on to number, let's see, 46, right? I tried to say 64 again. So number 46, which is here, this is Geraldo. And Geraldo recently won a lottery and chose to receive $100,000 today instead of an equivalent amount in 10 years, computed using an 8% rate of return. Today, he learned that interest rates are expected to increase in the future. Actually, as I'm recording this, this is the day that interest rates are expected to increase in the future, and the stock market is crashing. It's going down about 1,000 points. So anyhow, not sure. I hope that Geraldo's investing in fixed income investments that earn interest as opposed to stocks. But is this good news for Geraldo given his decision? Let's assume Geraldo is going to invest the money at the higher interest rates, and so he's actually going to benefit from this. So it is good news for him because if the discount that he incurred taking the equivalent amount in 10 years is at 8%, then it was only discounted at a lower rate than what he can earn going forward into the future. Let's say he's going to be able to make 10% or 12% going forward. And so that's good news for Geraldo. When he gets 10 years out, he'll have more than $100,000 because his rate of return will be compounding at a higher interest rate. So good, well done, Geraldo. Okay, let's go on to number 54. Hyundai, another Korean company, like our friends at Samsung, is considering opening a plant in 2 neighboring states. One state has a corporate tax rate of 10%. If operated in this state, the plant is expected to generate $1 million in pre-tax profit. The other state has a corporate tax rate of 2%. If operated in that state, the plant is expected to generate $930,000 of pre-tax profit. Which state should Hyundai choose? Why do you think the plant in the state with the lower tax rate would produce a lower before-tax income? Well, my notes say discuss and get students' ideas. So if you're hearing this now, I don't have any student ideas to give you, but let's suppose that we have $1 million in pre-tax profit, and our tax rate is 10%. So after the 10% corporate tax, we'll only have $900,000 left before we get to the federal tax. Hopefully the federal tax is the same from state to state, which it should be. So we'd start with $900,000 in the first state where we earn more pre-tax. And then in the second state, we have $930,000 of pre-tax profit. And if we apply a 2% tax rate to that, then we're only going to have, we won't have $100,000 in tax like the 10%. We'll have, $18,600 in tax. So our after state tax will still be, over $910,000, $911,400 actually of pre-tax, or at least, after tax, but perhaps prior to the federal tax rate. So in this scenario, Hyundai would choose the lower tax state, which they typically do. A lot of foreign manufacturers, when they come over nowadays, they choose to set up shop in states where the labor costs are lower and where the tax rates are lower, so they tend to go to Texas and Florida. The Carolinas generally have lower tax rates than, say, California or New York. So anyhow, those are my ideas, but feel free to add your own. And then for number 62, this is the Kamiko Tanaka investing in lima bean question. And I said, I'm going to post my worksheet. So I'll post that also in your materials, and you can see how I analyze that. But anyhow, that's the homework for Chapter 3. Hope you enjoyed it. Keep up with your work, and we'll see you in class. Have a great day. Bye-bye.